Hey, what's going on, everybody? Welcome to another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, March 17th, and today is St. Patrick's Day. Now, contrary to the Facebook and internet rumors and innuendo, I am not tipsy. I have not been drinking any Guinness or any Jameson's Irish whiskey, nothing like that. Not yet, anyway. In fact, I just turned down a green Jello shot here in my office building. So no liquor for me, not yet. I've got to be completely clear for all you guys here on social media. Now, you also may be looking at me wondering, well, he's not wearing green. What the heck's going on? Isn't he in the spirit? Well, no, I'm not wearing green. But I am hoping that this book will be enough green for us. So let's put this book up here. This is The Smart Retirement Strategy. SMART being an acronym for strategic movement around retirement taxation. So green is not just for the Irish. It's also the color of money. And you know who also loves green, the color of money? Uncle Sam, because he's coming for you. And that's why on the back of this book is George Washington. I hate taxes, and you should too. Look, that's a big part of what I do here at my firm, Sneller Financial Services, as I hate seeing my fellow American citizens overpay on their taxes. And Uncle Sam knows this. In fact, if you think about back to last week, if you caught last week's podcast, what was I talking about? I was talking about the huge levels of debt in this country. I was talking about how all of the major government retirement programs are broke. Social Security projected to become insolvent by 2034. Medicare projected to become insolvent by 2026. How is the government going to fix all these problems? And I said, they're going to raise taxes. Well, what happened since then? What's happened in this last week? Well, your wonderful Biden administration just introduced the first major tax hike proposal in almost 30 years. In almost 30 years. So this new proposal will be the first proposal to significantly raise taxes since 1993. I was 13 the last time they voted to make a significant increase to the tax rates or to taxation. Wonderful. Okay, well, look, this is going to have an enormous impact in several areas, but as a financial strategist and more specifically as a retirement planner, I'm going to focus in on that area. And that's where this book comes into play. Smart Retirement, Strategic Movement Around Retirement Taxation. Because I want to talk about helping you keep more of what you have earned and paying less in taxes to the Internal Revenue Service and to our wasteful government, right? It is unpatriotic to overpay in taxes. So if we're going to talk about helping you in retirement keep more of what you've earned, we've got to start by killing some sacred cows, specifically killing one sacred cow. And what is that sacred cow? Well, it's the traditional pre-tax 401k. That's the sacred cow. We have to kill all of the myths and all of the rumors surrounding the 401k. Look, I mean, we've been hearing for the last 40 years that you should max out your tax-deferred retirement accounts, max out your 401ks, max out your IRAs. That's the smart thing to do. But have you ever stopped and wondered, where did that advice come from? Like, who created that advice? Well, that advice came from the financial planning community. That advice came from Wall Street, from the big banks, in conjunction with their big money cronies over in Congress. And isn't that the essence of what I refer to as the financial matrix? These big institutions getting together to create a narrative, to get you to think in certain ways, influence your thinking, So it will then influence your behavior, so that your behavior with your money will end up profiting them much more than it's going to benefit you. Now, that's a strong assertion. So keep watching this podcast, and I'm going to explain exactly why that is, why it does not make sense to max out your 401k and max out your IRA, how that is going to lead you to pay way more in income tax and will benefit the Internal Revenue Service and Wall Street much more than it's going to help you in your retirement. You know, Friedrich Nietzsche, and I hope that I'm pronouncing that name correctly. Friedrich Nietzsche once said that people do not want to hear the truth because they don't want their illusions destroyed. Let me repeat that. They do not want to hear the truth because they do not want their illusions destroyed. So if you want to bury your head in the sand about what the impact of future taxation is going to have on your retirement, go ahead. This isn't the podcast for you. Keep maxing out your 401k. Keep maxing out your IRA. I wish you all the best. Look, we have a choice to make here. Do we want to take the red pill or do we want to take the blue pill? Okay. So if you decide to keep watching this podcast, it's because you don't want me to be gentle. You want the honest to God truth, however harsh that might be. Okay. So keep watching. So people ask me all the time, Ron, how much should I contribute to my 401k? Should I contribute to my 401k? So in this episode, I'm going to address that question. Should I participate in my employer-sponsored 401k? And my answer is maybe, maybe not. Maybe or maybe not. Look, in this episode, this is the question that we're going to address. Should I participate in the 401k? Keep listening and you'll understand why that's my answer. My general answer is only contribute up to the match and not one dime more. Only contribute up to the match, not one dime more. Maybe, maybe up to the match. Look, it's a good match if it's dollar for dollar, right? Like if you put in 5% and your company matches 5%, so it's a total of 10%. Now that's a good match. Now, if they do a match where they're putting in 50 cents on the dollar, like you have to put in 6% in order to get them to put in 3% for a total of 9% match. That's not really that great of a match. And I'm going to explain the math on that here in just a little bit. Most people would say, hey, that sounds pretty good, right? Again, but also depends on how your 401k is managed. How is it performing? What are the investment fees like? How long does it take for you to be vested in the program? Because look, if there's a 5-year vesting period and you leave the company before then, you leave all the 401k match behind. I personally know this, right? You leave all the 401k match behind. So the vesting period is also something that we need to take into consideration. So I would say only the match, and then anything you were putting in over and above that match to redirect that into something far superior than a 401k, far superior. And people hear that and they go, whoa, what is it? Look, here's the bottom line. Following this old outdated advice, because look, back in the 1980s, when this advice came out, the top tax rates were 50%, 60%, 70%. Back then it made sense. But in 1986, I think it was, Ronald Reagan came along, changed the tax laws, which dramatically lowered tax rates. Except look, Wall Street and the IRS, they've been giving you that same cookie cutter advice for the last 40 years, even though it's probably not the right advice anymore. So look, what makes me say this? Well, I'm in the retirement planning space. That's my specialty. And I see Americans all of the time outliving their money, running out of money before they run out of life. And that's not a good place to be in. So this is the wake-up call that they get, that taxes, the erosive power of taxes, because we all understand, right? That's why I take so much time talking about taxes. Taxes are the number one expense that people have in their lifetime. And people don't understand the impact that it has on their retirement income. And because they did not plan for the taxes, they didn't see the tax train coming. That's a huge part of the reason why they run out of money. So if we're going to contribute to a 401k and if we're going to take the match, we really need to understand what we're doing and what the ramifications are, right? First of all, we need to understand that this is a qualified plan. That's what they're referred to, right? A qualified plan. Well, it's qualified by who? Well, the federal government. That's what that means. The federal government, ultimately, they're in charge. So do you realize that if you decide to contribute to a 401k or to an IRA, you are entering into a partnership with the federal government, with the Internal Revenue Service. And at the end of the day, it is the Internal Revenue Service who ends up dictating how much of that money is actually theirs, because they get to dictate the tax rates when you withdraw the money, and they get to dictate the rules of the account, such as imposing a 10% penalty for early withdrawal, the RMD rules, things of that nature. So you have to understand, you're not in control. This is a partnership, and it always has been. And if you're okay with that, great, you're okay with that. But if you're not, and you want to look at some other alternatives, keep watching, because we're going to talk about some great things that you can do to take back control of your money. Now let's talk about how these tax deferred accounts work, these 401ks, these IRAs, because a lot of people like the fact that, hey, I get a tax deduction right now. Meaning if I contribute $10,000 to my 401k right now, that means that's $10,000 that is removed from my earned income. I do not have to pay current income taxation on that $10,000. And then it grows tax deferred. But what most people forget is that you don't save on taxes. You are simply avoiding taxes and delaying those taxes until later. And if tax rates end up being higher when you withdraw that money, you just cost yourself a bunch of money by contributing to a 401k, didn't you? You just cost yourself money. Now, look, this advice came out because the concept was, look, well, when you retire, you're going to end up being in a lower tax bracket. Again, back then, the top tax rates were 50%, 60%, 70%. But it's a lot different now, and it's been different for 20 years. Look, people who have done a respectable job at building a retirement nest egg, they don't end up retiring in a lower income tax bracket. They're usually in the same income tax bracket, sometimes even higher, depending on like if they have a pension that provides additional income on top of their 401k. The only people that I've seen who end up being in a lower tax bracket are people who didn't do a good job of saving. Maybe they didn't make a very good income, or they didn't do a good job of saving. Okay. But if you're a saver and if you have a 401k, you can put that money in, but just beware. You're going to have to pay the piper on the back end. Look, Joe Biden just said that he is working right now to raise your taxes. Okay. And what are these programs, and what is the nation's debt going to look like 10, 20, 30 years down the road when you're ready to retire? So let's look at an example here of how this would actually work. So let's say that your employer wants to encourage you to participate in the company-sponsored 401k plan. And he says, we will match you 50 cents on the dollar. And you think, okay, that sounds pretty good. 50 cents on the dollar. So when I put $1 into my 401k, I'm actually going to have $1.50 working for me, because 50 cents of that actually came from my employer. And you think, okay, awesome. So you contribute $1, they contribute 50 cents. You contribute $1, they contribute 50 cents. And then once you're vested and you decide, okay, I want to take some of that money out. And when you go take out that $1.50, that $1.50 that you've had working for you, well, right away, you lose 1/3 of it to taxes. You lose 1/3 of it to taxes because you forgot you had to pay the piper. So you take out $1.50, you pay 50 cents in taxes. That 401k match, it's gone. Right there, it's gone. You just lost it. So really, in this scenario, your employer contribution, all it's doing is paying for the future tax liability. A future tax liability, by the way, that you created because of the decision to put money into your 401k. Now let's say that 150, it doubles to $3, and then it doubles again, and it keeps on growing. So all you're doing is you're building up a big pile of money for the Internal Revenue Service to go after later, right when they need the money, because they're becoming hungrier and hungrier for money, right? All of the debts, all of the unfunded liabilities, all of the stimulus packages where they're printing money. They're going to have to come up with some money somehow. So you, my fellow American taxpayer, you can bear the burden, or you could pay the income tax right now while, number one, we know exactly what they are, and number two, while they're historically low. And then we can transfer your wealth off the radar of the IRS for income tax purposes, grow that money for the future, and then you can take it out completely income tax free. Which option sounds better to you? So look, it might be okay to get the match, especially if you have a good match, like the employer matches 100% and they put in dollar for dollar what you contribute. Wow, that's nice. But again, the other thing we have to remember, you are limited to a certain percentage of your income and to a set dollar amount, okay? Again, because this is a qualified plan. It's government sponsored. The government, ultimately, they control it. They make the rules, okay? And so people end up, a lot of times I hear that they get a 5% match and they're overfunding it. They're putting in 12% or 15%. And I say, why are you doing that? And they go, well, isn't that the prudent thing to do? Isn't that wise? And I'm like, no. Look, if you really understood the impact on the back end of these decisions, I would only put in what you're being matched and then redirect every dime over and above that to something that's going to be tax-free at the end of the day. Tax-free when you withdraw the money, when you need it. And so you might be thinking, oh, you mean a Roth? Yeah, I like Roth, so maybe. And a Roth is a step in the right direction. But what I prefer to use is actually something that is far superior to a Roth. And they go, okay, I'm listening. Are you? Okay, here we go. Look, if this information, if you're finding this helpful, if it's beginning to intrigue you, I would recommend that you share this video on your Facebook page, share it with other people, or you could text it to them or send them a message, because think about the people who may gain insights from the type of education that I'm talking about and who may be able to identify opportunities that they previously didn't know who existed, okay? And you're about to see that here in a minute. So first of all, like this video, comment on it, go to my YouTube page and follow Sneller Financial Services on YouTube and click the notification bell. So let's talk about this giveaway that I'm doing for St. Patrick's Day. Let's talk about this smart retirement book. This book has been an absolute game changer, both for me in the way I run my practice, and of course for all of my clients as well, where we implement tax planning into their retirement strategy. And of course, the author Matt Zagula, I don't know Matt. We've interacted on social media a few times, but the author Matt Zagula, I mean, he's distributed this book all over the country. It's helped hundreds of thousands of people retire in a more tax smart way. So where they actually have more after-tax spendable income than what they would have received in their 401k. And at the end of the day, isn't that really what retirement planning is all about? Producing spendable income that you can enjoy your lifestyle. So the first 5 people who share this video on their Facebook page, then send me a message requesting the book, I'll send you the book for free. It's on Amazon. It's like $38. I'll cover the cost of the book. I'll cover the shipping. I'll get it right to you. So again, the first 5 people who share this video on their Facebook page, and then just send me a message and let me know that you want a free copy of the Smart Retirement Strategies book. Okay, so let's talk about this Roth a little bit more. So if you think about it, because most people are not in a lower tax bracket in retirement. So why would we want to maximum fund their 401k or maximum fund their IRA and contribute further to this problem? And you've probably killed a lot of your deductions along the way, because if you've paid off your mortgage, we no longer have mortgage interest deduction. Your children are probably no longer minors, to where you don't get deductions for childcare and school and tax credits and things of that nature. If you're retired, you're no longer contributing to a 401k, so you've lost that deduction. Most people, when it comes to charitable contributions, when they retire, they tend not to give as much money. Now they give time, and time is not tax deductible. If you have a business, if you've retired from the business, you no longer have business expenses or depreciation that's tax deductible. So you've killed a lot of deductions along the way. And Congress keeps finding ways to raise taxes. So what? I mean, look, why do they raise taxes? We know why, right? I already mentioned it earlier, the wasteful government spending and the printing of all of this money to fund these programs. My heavens. Look, why don't you redirect these 401k contributions into something that's going to be tax-free on the back end? Because look, I can prove to you mathematically that if taxes go up and you use a tax-free vehicle on the back end, you will have 25%, maybe 33%, perhaps even up to 50% more net spendable income with a tax-free account than what you would have gotten with your 401k. Again, anywhere between 25% to 50% more net after-tax spendable income. Or your income will last longer with the same amount of money than if you had it in an IRA or 401k. And you'll say, why am I putting in any more than I'm being matched? I'm putting in 5%. They're matching me 5%. So I want to redirect this other 9% into something that is far superior to a 401k. Are you beginning to get it? And you'll be way ahead at the end of the day. So let me tell you about my favorite vehicle. As I mentioned, I do like Roth accounts. I do have an old Roth 401k, but my favorite vehicle is something that savvy CPAs and tax attorneys refer to as the rich man's Roth. The rich man's Roth. And when they call it that, I kind of snicker. And I've seen it written in articles and things of that nature, because you don't have to be rich to own one. You could put in $500 a month if you want. But look, savvy people, if they're taking a 401k match, they don't want to turn all of their money over into a government-sponsored plan. They don't want all the rules and the restrictions of the Internal Revenue Service on all of their retirement money. And wealthy people can't even use Roths. If you make too much money, you're disqualified from owning one. So this rich man's Roth, this is where wealthy people store their money. This is where financially savvy people store their money. Heck, even corporations save their money in these accounts, and banks accumulate their capital in these types of accounts. The rich man's Roth. In fact, back in 2008, when things were getting really, really bad, people were losing 40 to 50% in their 401ks and in their Roths. A lot of banks had failed. Many other banks were on the verge. They were on the brink. Did you know that the federal government went to the 5 largest banks in the country and asked them, where is your money? Where is your money? Because banks, they're in the business of lending, and that's how they make their money. That money's moving. It's going in and out. They're lending it and they're re-lending it. And I'm not going to get into fractional reserve banking and creating money. That's a different topic for a different time. If my friend Brandon Perry's watching, he'll get a little snicker out of that. But banks move their money. That's the velocity of money. But they are actually also required to have capital reserves. They're required to keep some in capital reserves. And it's called Tier 1 assets. That is liquid and unassailable. It's liquid and it's of prime safety. Okay. So that's basically what the government was asking these 5 largest banks. Where is your Tier 1 capital? And do you know where it was? With insurance companies in a certain kind of insurance contract. Do you know what kind of insurance contract it was? Life insurance, cash value life insurance. That's the rich man's Roth. And I'm not talking about the kind of life insurance where you're trying to get maximum death benefit in case you die. I'm talking about the kind of life insurance where it's maximum funded for high cash value and maximum retirement cash flow, tax-free retirement cash flow. Why insurance? Well, in the banking industry, it's called BOLI, B-O-L-I, bank-owned life insurance. Corporations do it. It's called COLI, corporate-owned life insurance. And the reason that they put this money with insurance companies is because insurance companies are a $1 trillion industry. They are the backbone of America. They're the backbone of the world. They have gotten the economies and really the economies of the world through some of the toughest times, through the Great Depression, through the inflation and even stagflation of the 70s, all the way through this last great financial recession that we had. So that is the rich man's Roth. Properly funded, properly structured, maximum funded life insurance contracts. And it's kind of funny because a lot of times when people hear that, they tune out because they don't get it. And they say, I don't need more life insurance. And I say, perfect. This isn't about the life insurance. They focus on what it is instead of what it does. So they focus on what it's called instead of what it does. And what it does is it allows you to grow your capital income tax free, giving you increased control, liquidity, and utilization as you build your equity, income tax free. This is what banks do, and you can do the same thing. You can have taxes and interest working for you instead of against you, just like the banks. Now, I do like Roth accounts, and they have two main benefits. Because we're using after-tax dollars, number one, they accumulate money tax-free, and number two, you can take tax-free distributions. So the distributions are tax-free as well. Now, the rich man's Roth has had those two benefits for over a century, grandfathered in as a sacred tax-free cash cow for over 100 years. In the Internal Revenue Code, section 72E, 7702, and 101A. It's in the tax code. And in fact, the Roth IRA, in the tax code, the language was written, patterned after life insurance contracts. So see, these insurance contracts, these rich man Roths, they have 4 additional benefits over and above something like a Roth IRA. Number one, I can put in a whole bunch more money. The 401k and the Roth IRA, they're limited by a certain percentage of income or by a dollar amount. 2, if I start a Roth and I need that money back out in less than 5 years and I'm under 59 and a half, guess what? There's a penalty. Now, I could put $100,000 into a rich man's Roth, and let's say 30 days later, I needed $80,000 of it back. I can do that, and there's no penalty by the IRS for doing so. Number 3, these insurance contracts, these rich man Roths, they give you guaranteed growth in all economic times, and I can never lose my money when the economy is going down. I still get guaranteed growth for a tax-free retirement. And then number 4, finally, at the end of the day, when I die, anything that is in my rich man Roth account, it blossoms and it transfers income tax-free. Now, what does this mean? If I died right now, one of my insurance contracts has about $50,000 of equity in there. But if I were to die right now, that thing would blossom and it would pay out $500,000 income tax-free to my wife. Income tax-free to my wife. And there's not a Roth in the world that can do that. And so you can set it up to go to your children or your grandchildren or a charity or a trust. So are you curious? If you want to learn more about how to diversify and create a foundation for a tax-free retirement, where you could put every dime over and above what you're being matched into your 401k. Now, let's do this St. Patrick's Day giveaway. Again, share this video on your page and then send me a message on social media requesting the book. The first 5 people to do so, I will send you a free copy of Matt Zagula's Smart Retirement Strategies, the strategic movement around retirement taxation. This isn't a difficult read, and you'll learn how to bring the entire strategy together, combining your taxable accounts, your tax-deferred accounts, and your tax-free accounts, including your Roth IRA and including the rich man's Roth, combining all of those into one optimal strategy for the optimal tax-free retirement. So I will pay for the book, I will pay for the shipping, and you can learn what you can do better than just following the herd and putting your money into traditional IRAs and 401ks. And when you do that, you're just kind of hoping that Uncle Sam won't rake you over the coals with retirement taxation and that you won't end up outliving your money at the end of the day. And don't forget to register for my upcoming online seminar, Crashes in Taxes. I will link the event information in the comment section here below. Again, shoot me over a message for a free copy of Matt Zagula's Smart Retirement Strategies book. Well, that's my rant. And as always, thanks for listening.